Hey guys, welcome back to my channel. And in this video, let's talk about residential on this side and we got commercial on that side. Now, look, when I do mention commercial, I'm not personally talking about going and buying a block of offices, right? I mean, obviously, and we all know COVID killed that, people working from home and stuff. I'm talking more about, we're seeing lots of investors in the SAPA network. They're going out and perhaps they're buying a block of flats. So it's residential, or maybe 3-4 stories of residential with commercial at the bottom. But because of the nature of that property investment, we'll take out what's called commercial lending. And that's what I want to chat to you about now is let's talk about residential lending versus commercial lending. So in the residential home loan space, the type of loan to value that we would get can be anything up to 100%. And we're more than likely talking prime minus, prime plus. But what dictates and why do some people only get 90% loan to values and why do some people get 100% and they get prime minus? What do the creditors look at? So what they will look at is they will look at your credit score. If you're an individual and you don't have a credit score or your credit score is very poor, the banks will look at it and go, well, this, I'm happy with the property. I tick the box. We see value in the property. I can see this person's employed. The credit score is not bad. It's not great. It's not great, and therefore there's a higher risk. As soon as there's higher risk in the eyes of a bank, that's when the interest rates start to go up. And in some cases, the loan to value might go down because of your credit score. So one of the most important things that we teach our property investors is the importance of your credit score, guys. Protect it. It won't cost you anything. Twice a year, you can download a free credit score on yourself to see what your credit score is. And you want to make sure that it's 100% purely for negotiation issues with the bank. Now, in the residential home loan space, this is where you're going out and you're buying a flat, you're buying a family house, or maybe it's a property that we convert to a commune. Yes, we're going to make sure we've got all our paperwork and building plans and consent if the banks are going to lend us. And we'll get, I'm going to say up to 100%. Why do I say up to 100%? It's not just your credit score that'll dictate the loan to value. What's also going to dictate it is you might go to a bank and you want to buy through a company. Some of the policies that the banks have, it says, if you're buying a property in a newco or a company, that they'll only give you 90%, 95, 85%. So the policy is written that an investment property through a company, you're not going to get 100%. What I do want to say to you on that, though, is that through my experience, when we use Sam, who helps our investors get bond finance, 99% of the time we're getting 100% finance through companies. But just note that every bank, Standard versus ABSA versus African Bank versus Nedbank versus FNB, when it comes to companies and investment properties, they've all written their own policies based, and in the policies will dictate and tell you what loan to value and interest rate they'll be looking at. And after that, they look at you as the individual and they look at your affordability, your disposable income, and your credit score. So you want to make sure that you tick all the boxes. In the residential space, Andrew, can I get finance if I'm not employed, but I own my own business and I pay myself a salary? So Andrew, I'm employed, but are you a director? Yes. Okay, well then you're self-employed. So a lot of entrepreneurs go out there, they have a business. It could be a traditional business. You're the director, you're the shareholder. Doesn't matter if you pay yourself a salary. Yes, you are employed by yourself. The banks will still see you as self-employed. As soon as you're self-employed, that's actually okay. No problem if you're self-employed. Can you show me right now? Can you give me 6 months worth of management accounts, profitable management accounts? Are they all in order? Is your tax up to date? Have you filed your annual financials? Here's the thing. If you tick no, you might be making a lot of money, guys. But if you can't show it on paper, if you don't have management accounts, if you haven't filed your annual financials, the banks aren't going to lend to you. You see, yes, when you're employed full-time and you tick the box that says employed full-time and I've got a good credit score and I do have disposable income, quick, easy, no problem. As soon as it flips to self-employed, a lot of people will tell you, oh no, it's a mission, it's a hassle. It's only a mission and a hassle because you don't have your tax affairs in place. You don't have management accounts because you're an entrepreneur. You're so busy focusing on product and sales and building your business. The last thing you're thinking about, and you probably have this if you're self-employed, a shoebox, and you chuck all your receipts in the shoebox, and then you go to your bookkeeper accountant once a year, and you say, please do my financials. How do I know that? Because that used to be me back in the day. Every single month now, by the 15th, I want to see management accounts for all my businesses to make sure that they're all up to date, tax affairs are good, and we are in profits. You must take the same stance if you are self-employed or a business owner, because that's going to help you get lending. Because think about it. What's the bank looking for? When the bank wants to lend to you or your company, what are they looking for? All they're looking for is affordability. Can the entity, this company A, afford to repay the loan? If no, well, then we're not going to lend it to you. So if you are showing, it might be that you're actually making a profit, but you're showing losses in this company, but you know in your head, oh, but I know I'm making lots of money, but you're showing a loss. Why would the banks lend to the company? Because there's no disposable. No, it's no different to your personal capacity. If you show income, if you show profits in your personal capacity and your credit score is good and you're employed, tick, 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 get the loan. It's the same as a business owner or self-employed. Now, with residential home loans, we're talking 100% loan to value. Yes, for those young professionals out there, there's some products where you can even get 105% loan to value if you're a young professional. Some of the banks have that awesome incentive for you. And banks like Absa Home Loans have the future rental product where you can take a property that you haven't bought, take up to 70% of that rental income, add it to your disposable income now to help you buy more properties. That's a big cha-ching. And then we start talking universal loans, right? And the banks will lend to you also based on the value of the property. So it could be that you're buying a property for 2 million rand and the banks only see value at 1.9. So they look on the internet or they come view the property and they reckon that property is only worth 1.9. Guess what? They'll only give you 1.9 because that's the value they see. You've overpaid. Or it could be that you're paying 1.9 million. That's the purchase price, but the value is 3 million. You've just bought it below market value. Cha-ching. That's fantastic. The banks will not lend you on 3 million. They'll lend to you on the purchase price, the 1.9. However, what I want you to think about is as you sign the offer to purchase and you get the loan, when you get introduced to the bond originator, not the bond originator, the bond attorney at the bank will assign to you. I want you to register the bond for 3 million. So you'll pay slightly higher bond attorney fees because now we're registering the bond at 3 million, not 1.9. So what happens today? When you take transfer, the banks lend you 1.9 because that's the purchase price on your offer to purchase. But you've now registered a bond at a higher price at, say, 3 million, which means providing your affordability, because the banks and the banks at the time of refinance, if they see value in the 3 million, which they will, because we've taught you how to do your due diligence, we've taught you how to work out the market value. We know that after doing a refurb of 400,000, that property is going to be worth 3 million any day of the week. So now when it's 6 months line, 3 months or 6 months down the line, we want to, not even the word refinance, just take equity out. The bond's already been registered at 3 million. The banks do a check to go, yes, Andrew Walker, your company can afford to repay a loan at 3 million. Or Andrew, in your personal capacity, there's enough disposable income to support a loan at 3 million. And yes, we see value in the equity. You can just take out the difference of the 1.1 million. So if you think about it, if you bought a house for 1.9, there's buying costs, right? Let's just say your buying costs were 100,000 rand. Keep it simple. So you've got a bond of 1.9, you put 100 grand in, don't you? But then there's also a bond, not a bond, there's a refurb of 400. So you chuck 400 at the property. So you've now invested 500,000 rand of your cash, haven't you? So now you're in the deal for 2.5 million. It's worth 3 million. You can say, okay, cool. I'm taking 500,000 rand back out the property to repay myself for the buying costs and for the refurb costs. And that's the beauty of the whole refinance game. Now, the refinance game, that strategy is fundamental in property investing. It works the same in commercial. Now, when we go to commercial, let's say a lot of our clients at the SA Property Investors Network are loving buying these blocks of flats, 3 stories and above, where in some cases you have shops at the bottom, and then you have your second, third, fourth floor. right? Now, if you send home loans there, there's a reason why it's called home loans. That's not a home. That is a commercial building for property investors, because there's shops at the bottom and there's residential flats, or it could be the whole block is residential flats, ladies and gents. You're still going to get what's called a commercial loan for residential purposes. Now, you're not going to get 100%. You'll be getting in your first purchase more than likely 60%. Look, there are banks out there like TAP where you'll probably get up to 80%. Where as soon as when your loan to value is higher, though, you expect to pay prime plus 3 as an example. Some of the banks are 60%. It might be that you get prime, but remember your lending terms might be a bit short, like 10 years, 15 years. Don't get me wrong, I have seen it happen recently where one person got a 20-year loan in the commercial space. First time I'd heard about it. But a big difference with commercial guys is you need to come with equity and the deposit. The banks will back you as the jockey. So if you're a first-time buyer, never bought an investment property before, don't go buy a big block of flats, because the banks probably won't lend to you because you're not the right jockey yet. You need to come with a level of experience, and you've got to come with a balance sheet, or you've got to come with some equity for that deposit. And that's obviously what we'll teach you through SAP, and that's why we have SAP in Gold, is people that want to take that next jump often think they need millions, and yes, you do need millions. But what some investors have done is we've clubbed investors together. They've done joint ventures. If they never had their own cash, but they did have experience, and they've jumped in and they've bought the properties at the right yield. Now, banks won't look at the bricks and mortar of a commercial building. They'll look at the net yield. They'll value the building based on the cash flow, i.e. the net yield of the property. So we can be buying the property at a gross yield of around, as an example, 18%, net yield. The banks will look at the property. They're used to lending on, say, 12%, 13%, and the whole refinance game then starts with your second purchase, where they'll say, you're buying your second building, you bought the first one at the right price. Based on turning that building around, we're now full occupancy, we're collecting all the cash flow, my net yield has gone up, my cash flow has improved. The banks will release equity out of the first investment, and that money I'm going to use for my 40% for the next property. And that's how these big investors are doing it, is they're rolling their cash to the next one. But I think, just to summarize that, the big difference between residential and commercial is residential, I'm talking around at 100% loan to value, prime minus prime, maybe prime plus 1, depending on credit score. There's a difference when I'm buying my personal capacity through a company, know those differences. And the commercial world, where we're talking 60 to 80%, loan term of 10 to 15 years. Banks will back the jockey. So it could be a really good deal, but if you're the wrong jockey, they probably won't lend to you. So it's two separate worlds, and that's what we do, ladies and gents. That's SAP. Is we take people, we build them up, give them the experience, get them buying property, and we help them take that leap of faith into the commercial world, because that's where the big cash flows are. So guys, if you have any question around lending, please, in that comments box, fire away, ask questions. More than happy to reply and help you guys along your property journey. If you did like this video, like it, subscribe, and I'll see you in the next one.